Abneesh Roy joins in then from Edelweiss Securities to throw some more light on which company is looking more viable at these high inflationary times right now. Abneesh, hi, good morning. Good to have you on the show. Abneesh, clearly raw material inflation is posing a major risk, especially for FMCG companies. Could we see them see a decline in their margins, more so in the coming quarters, because there's only that much elbow room that they'll have to be able to pass on these hikes onto the consumers before it starts eating into their volumes as well?
Sure, you're right. So there are three things. One is all consumer companies are seeing gross margin pressure, but there is a difference. If you see consumer staple companies like Hindustan Unilever and Nestle, their EBITDA margin compression ranges from 45 bips to say 90 bips. So it's a very small compression. Yes, gross margin compression is a bit higher, but what's happening is advertising spends and other cost items are getting rationalized, and we expect that to continue. On the other hand, if you see paint companies, they are seeing 4-decade high gross margin pressure. So clearly their things are much more linked to the crude oil prices, and there is titanium dioxide issue also. And there is a shortage of some of the raw materials, so distribution and sourcing currently, there is a fair bit of chaos for the chemical companies, for the paint companies. So there is one big difference that I would like to highlight. Second is this necessarily bad from a medium long-term view? So, because consumer companies gain market share, the number one, number two player always gains market share in this kind of a very high inflationary scenario. So I would expect Hindustan Unilever to gain, for example, in tea because of the very high tea prices last 1 year. Now it is cooling off. Similarly, Asian Paint is clearly growing much faster, 34% volume growth. I don't think the smaller regional paint companies can grow at that level. So that is something which I would like to point out. Third is the worst behind in terms of gross margin pressure? I would think so. I think Q2 most likely was almost at the bottom, or maybe by Q4, definitely I would expect quarter-on-quarter margins expansion to start, because one is 7% price hike has happened by Hindustan Unilever and also Asian Paints, and 3 to 5% across the board. Consumer companies do have high pricing power, and definitely as we go ahead, because urban demand is recovering, I would expect the premium part of the portfolio to grow faster. So for Hindustan Unilever, cosmetics, skin cream should grow faster. For paint companies also, clearly urban cities are driving a lot of good premium growth, even in the smaller cities. So to that extent, most of the EBITDA margin compression is behind. Gross margin compression, I think 2 more quarters of pain is there for paint companies. But I would expect paint companies to cut advertising spends going ahead and the other cost items, and going into adjacency also, I would expect them to moderate that a bit, because there is a cost implication of diversification also. So they'll become a bit more rational.
Sure. Abneesh, what one has seen peculiarly in the week gone by in equity markets, that it's the high PE stocks which corrected post their earnings. Could we see the same phenomena hold true for FMCG stocks as well? Because the commentary from managements seems to be a little alarming when it comes to inflation and thereby the raw material cost pressures. Could we see a significant price damage and PE compression for FMCG stocks too?
Sure. So three things here. One, in the last 3-4 months, consumer companies had done relatively quite well versus the 1 year of underperformance. If you see, Hindustan Unilever moved up from 2,300 to all the way 2,800 plus, and now it has pulled off because of the correction the broader markets are seeing. Asian Paint, in fact, around 7-8 months back was 2,300, and then it went to 2,900, and then 3,300, 3,400. It has also pulled down now to around 2,900. So I would say some level of froth which was getting built up. We have seen that correction. Second, of course, is now the consumer companies are also seen as defensive. So if we are seeing a broader market correction, I think except banking, most of the other sectors are correcting. Consumer companies are also seen as defensive. So I would expect that at some stage, again, a lot of investors will see that, yes, these are companies in which very high pricing power is there. So medium long term, these companies will get back their peak margins, which I think will happen in FY23. Plus, they will gain the market share in the current scenario, which we just discussed. Because in very high inflationary conditions, the regional and small players are not able to manage the working capital and they come under huge pressure because they are very small and wafer thin margins. So always the number one, number two player gains market share. So net, I would expect investors to come back to Hindustan Unilever, Nestle kind of companies. We also like Godrej Consumer. Plus, some of the raw materials have started correcting. If you see for Hindustan Unilever, tea prices are now down 30% from in terms of raw material versus YOY. So clearly there is some good news there. Plus, as I said, 7% price hike has happened. And now premium part of the portfolio should grow faster because of the pandemic easing off, the travel coming back, offices starting. The premium end of the portfolio will do well. So we like Hindustan Unilever and Nestle and Godrej Consumer in the staples. In the discretionary, we like Titan, Aditya Birla Fashion, Jubilant Trent, and PVR, Inox, etc.
Okay, so you've highlighted quite a few names that we can look at, but just Abneesh, also comment about the statement that was made by the management of HUL with regard to rural growth. They said that rural is looking quite resilient. What about the other counters that could be affected by, or those counters that have a relatively higher salience towards the rural segment? Do we see that benefiting them as well?
No, so rural, in fact, conflicting signals are emerging. If you see Nielsen for FMCG, they have, in fact, said in the last 2 months, rural growth has slowed down and it is at 1/3 of the urban growth. This is not true for FMCG companies specifically. If you see HUL in Q2 did call out that their rural growth is decent. Yes, there has been huge rainfall in few states like UP, Bihar, and then now Kerala also. Then there is a deficit of rainfall in few states like Odisha, Gujarat, Rajasthan, etc. So we are seeing some weather-related disruption. Does it change the long-term thesis of rural growth? I don't think so. Rural FMCG per capita is 1/3 of urban. Second is we have seen the third consecutive normal monsoon, and we are also seeing government take multiple steps. We are seeing large state elections like UP now happening soon. So there will be a lot of subsidies for the farmer. So net, I think Hindustan Unilever, Nestle will gain because they have good exposure to the rural, especially Hindustan Unilever. Plus, as travel comes back, the out-of-home consumption will also gain, and both these companies will gain. So rural, I am not very worried as of now because of the Nielsen number, but I think clearly urban growth will grow faster in the next 2-3 quarters because of travel coming back, offices starting, modern trade picking up. So that's more of a near-term phenomenon. Long-term, rural should continue to grow faster than the urban for FMCG.
Abneesh, comment about ITC, because a lot of people look at this slightly differently. What are the factors that you're watching out for specifically with regard to ITC?
Yes, two things. One is near-term results of Q2, Q3 for ITC will be good. That's because ITC's cigarette business, the base is favorable. Plus, we have seen that cigarette consumption is reasonably sticky. Second is hotel business and paper business and agri and FMCG also should do well on a YY basis. That's one. Second aspect is slightly negative because now February 1st, the union budget will be there. In fact, Health Ministry has also formed a panel to evaluate WHO recommended on the cigarette and the tobacco taxes. So we would await for that. What WHO has said that the cigarette taxes as a percentage of the MRP, that should be around 75%. I think that's not going to happen. Some level of increase will happen by the February 1st. So if it is more than say 10-12% tax increase, it will be negative for the cigarette stocks. But if it is say 5% or 8%, that is not a concern because that will happen after 2 years. Also, I would expect value unlock in some of the businesses in ITC from a longer term perspective, say in the hotel business and the tech business, but these are more longer term. But definitely company has become more transparent. They are sharing the numbers for the tech business and for the hotel business. Also, they are giving more strategy in terms of expansion in the low capex fashion by the brand sharing, etc. I think those are very good strategy. So ITC stock, if you see last 6 years has not done quite well, except last 2-3 months when the re-rating in the broader markets happened. So now I would say the correction because of the parliamentary panel which was announced, that has already happened. But near-term results are going to be good. So I would expect around 10-12% upside in ITC stock from a next 6 months perspective. But because cigarette stocks do have the overhang of tax increase, I would have HUL and Nestle and GCPL as my top picks.
Okay. Abneesh, thank you so much for joining in, and you've given us quite a bit of perspective on the FMCG space as a whole. Pleasure speaking with you. Let's